Hi, this is Evan Hutcheson, CPA. I do tax preparation, tax planning, and bookkeeping for individuals and businesses. And one of the things I do with taxes is I help taxpayers file their tax returns online. So I don't actually have to do the taxes for them. I can just help them do them themselves. So some taxpayers like to do their taxes on their own. I'm just a helping hand. I can help out through screen sharing through different programs like GoToMeeting and a few other programs. But anyways, today I want to go over one of the common schedules of the tax return, the Schedule C. The Schedule C is for a lot of business owners who are either have a sole proprietorship or they have a single member LLC. So basically, if you own your own business and you're the only owner, and the business is not a corporation, then you would be filing a Schedule C. So the Schedule C is a schedule behind the main form, which is the 1040, and the net income from the Schedule C flows through to line 12 of the 1040 right here, and it pops up right here. So if we go to the Schedule C, there are obviously a lot of different types of businesses. So the example I'm showing is a flower shop. It's a pretty basic example that'll give you, I think, a good idea of how to file it, but just note that there are different ways, many different ways to file your taxes depending on the business that you're in. For instance, if you have a construction company, if you're building homes for people, you right here, the accounting method, you're probably filing on the completed contract method if you're a small home builder, which is a totally different way of filing your taxes than cash or accrual. Most small businesses are cash, and that's usually better for small businesses because with accrual you are recording you're recording income that you haven't yet received the money for, but you're owed it. So if you have receivables out there, if your clients owe you money because you've already performed the work for them, that money would be included in income. It would be included right here if you're filing on the accrual basis. So cash, you wouldn't be filing that income, and your net income would be lower, so your taxes would be lower. Of course, the negative side of it is the bills that you owe money on, you haven't yet paid the money out, but you would still be recording the expense on accrual rather than cash. But for the most part, cash is simpler, and it usually is a little bit better from a tax standpoint than accrual for small businesses. So most of the businesses I deal with are on the cash basis. This is somebody named John Doe. Here's his social. He owns a flower shop called Flowers and More on 123 Main Street. You can look at the a list of codes for different businesses, different industries. The flower shop is code 453110. So this is pretty standard information. You fill out this info right here. Did you materially participate in the operation? Usually the answer is yes. If it's your business, it's going to be yes. The reason they ask that is if you did not materially participate and you are recording a loss, you might be hit with the passive loss rules, which mean the passive loss limitations, which would disallow the loss to be shown on your income taxes. So for the most part, it's definitely beneficial to say you materially participate. But for the most part, you do materially participate. If it's your job, you definitely do. Now, did you make any payments that require you to file 1099s? If you pay contractors or outside labor over $600, you are going to be required to file 1099s. So if you did that, you would mark yes right here, and hopefully you did file them, so you would mark yes right here too. Now if you marked no right here under the question, did you file the 1099s, and you marked yes right here, or are you supposed to file 1099s basically, then you're going to be in a little bit of trouble. They're going to look at you funny. They might even audit you, because that's kind of a trigger that says, alright, this person should have filed 1099s, but they did not. So just make sure if you're supposed to that you do. So John Doe, the owner of Flowers and More, earned this amount of money from his flower shop business. Since he sells flowers, he sells gifts, he sells all these things, he's got inventory on hand, which means he has got cost of goods sold. Here's his cost of goods sold. This is basically, he purchased in $132,788 worth of plants and gifts that he sold. He sold them for $352,000. So his gross income is the gross earnings minus the cost of goods sold equals the $219,000. His gross margin would be $219,492 divided by the $352,280. If you want to look at some indicators like that, that's just a percentage of your gross income divided, or your gross income divided by your gross sales. So this is the part one. This is the income part. It's your income minus your cost of goods sold. Of course, all businesses don't have cost of goods sold. If you're a service business, you don't have it. There's various businesses that don't. But since this is a retail business, they are definitely going to have it. Here are some other expenses, some pretty common expenses that they have. Advertising, they have $273. Car and truck expenses. He's a flower shop owner. He delivers flowers. That's one of the things they do. So with mileage, with car and truck expenses, you have the option of taking either actual expenses, which would include the purchase price of your vehicle, depreciate it. So you would depreciate your vehicle, and you would take your gas and your insurance and your repairs and all those sorts of things and add them together. But with him, he drives so much that he has more of a benefit taking the standard mileage. And most of the time, most companies do have I would say 80% of the companies that I do taxes for use the standard mileage because it's more beneficial. So in 2014, the standard mileage rate was 56 cents per mile. So for every business mile that he drives, he gets 56 cents of a deduction. So he he drove whatever 21,557 is divided by 56 cents per mile, and I'm about to pull it up right now just so I don't have to do the calculation. He drove 38,495 miles, so he gets that amount of deduction. He paid out, he doesn't have payroll, so he paid out contract labor of $33,838. Now that's they'll look at, the IRS will look at that too, and if they see all that in contract labor and you marked no right here that you shouldn't have filed 1099s, they'll look at you funny there too, because they see all this money that you paid out to outside labor. You did not have payroll, you paid it all up to outside labor. They're going to assume that you probably should have 1099s, so just be aware of that too. Depreciation, he bought a computer and some furniture in 2014. So in 2014, you can take Section 179 expense. It's the type of depreciation that allows you to write everything off rather than just a portion of the asset per year. So if you go to add, it'll pop up this Form 4562, which is a summary of your depreciation, will pop up. And here's the maximum amount you can take: the $500,000, the $2 million, the threshold cost. His two pieces of equipment that he purchased is listed right here: a computer and furniture for these amounts. So the 841 plus the 1855 equals the 2,696. He gets to take that full deduction because he's taking the 179 deduction. If he did not, he would take it based upon the depreciation per based on the years of depreciation per equipment. I didn't say that right, I'm sorry. A computer is 5-year property, so that would be depreciated through 5 years. Furniture is 7-year property, so that would be depreciated through 7 years. As an example, Real estate, commercial real estate is 39 years. Residential real estate is 27.5 years. Those cannot be written off completely. You cannot use Section 179 on real estate. Leasehold improvements are, if they're qualified, they're 15 years. So those are just a few examples. But computers and furniture, you can always write these off if the 179 is in existence for the year, and it is for 2014. So he's writing off 841 plus 1855. If he has income of 0, he doesn't get to write this off. It has to carry forward to the following year, but he definitely has income more than this, so he gets to write off the full amount. So if we go back to the Schedule C, you can see that full amount right here, 2696, as an expense. Insurance, 1632, he writes off his business insurance, which might be general liability, workers' comp, things like that. If you're working off of your profit and loss statement for your business, which a lot of people do, most of the stuff on the statement is deductible. However, there are a few things that aren't deductible that you got to reconcile for. For instance, life insurance is usually not deductible. So if you're paying life insurance through the company and it's on your profit and loss statement, you are still not going to take the deduction for it. So you just make sure you don't put it here. Another thing is meals and entertainment. Deductible meals and entertainment right here, $5,321. 50% of your meals are deductible. So John Doe really spent $10,642 on meals and entertainment. He can just take a deduction of half of it. So make sure you only put 50% here. And then other stuff is pretty simple. Legal and professional fees, it's just straight up a number. Office expense, rent or lease. Here, this line's for vehicles and machinery and equipment. This line, it says other business property. This is where you would put your building lease. Supplies expense, taxes and licenses, utilities. Other expenses right here comes from more unique expenses that aren't on this default template list of expenses. So this $11,699 comes down from down here. These charges right here, which add up to the $11,699. Bank charges of $18, merchant fees of $8,500, telephone expense of $10.54, uniforms of $295, computer and internet of $15.98, postage $61, shipping $160. And up here, this is a detail of the cost of goods sold we saw above. Remember, the cost of goods sold was $132,788. The way that is determined for inventory businesses is we take the inventory at the beginning of the year, which will come from last year's tax return, end of the year from last year. So the beginning of the year inventory, we add the purchases for the year. So we add the $133,483 to $4,305. We come up with $137,788. That is the total amount that was purchased or was already on hand. Now we subtract the ending inventory, which is at $5,000, because that was obviously not sold. It's still an ending inventory. All this was sold minus the $5,000 because we had $137,000 of inventory. Now we have $5,000. So subtracting the $5,000 from the $137,000, we sold $132,788. So we stick that up there under part 1, cost of goods sold. So that's a quick little kind of summary of how to file Schedule C. It's pretty basic. Like I said from the beginning, businesses are all pretty different, so you might not utilize some of the things I talked about, and you might use some things that I did not talk about. And I'll try to make more videos in the future to cover more areas, so you can hopefully have something a little more in tune to what you're doing. If you do have any questions, feel free to call, email, just get on my website, go to the contact page if you want, and I'll try to get back to you as quickly as I can. Like I think the note says on the YouTube video, I do a lot of tax preparation online for people, and I also do tax preparation help. So if you're filing on this, the free fillable forms on the IRS website, which is free, and you're the type of person that wants to do the taxes yourself, or you're the type of person that doesn't want to give away information like your social or your bank account numbers or anything like that, you can call me. We can do a shared screen viewing, and I can kind of go over and kind of walk you through the process of filing your return and give you some input and tell you what you're doing wrong and things like that. So I hope you got a little something out of this, and I will talk to you soon. Thanks a lot. Bye.